So what role can infrastructure play in a portfolio? Well, there's really three key things I'd like to point to. The first is that infrastructure has the ability to offer consistent returns with relatively low levels of volatility through market cycles. And that's because, as I alluded to a moment ago, infrastructure assets are essential services assets. And that means that they're assets that people have to use on a day in and day out basis. As an example, think of electricity distribution networks, which distribute energy to communities for lighting, for heating, for cooking and so on. And that's exactly what I mean by an essential service asset that we all need to use every single day. And it's due to the nature of those essential services that they provide that these types of assets are often less influenced by economic factors than many other businesses. In addition, infrastructure assets often enjoy the protection of monopolies or benefit from high barriers to entry in the markets in which they operate. And this means that they're often free from competitive pressures which are faced by many more traditional companies. Secondly, infrastructure can provide consistent long-term income yields. And that's because infrastructure asset revenues are often underpinned by regulation or by long-term contracts. And that provides a high level of certainty around the cash flows which infrastructure can generate for investors. In addition, infrastructure asset revenues are often linked to inflation, which can help investors protect against the erosion of their investment by inflation over time. And then a third and important benefit is diversification. Overall portfolio diversification is improved when all of your assets aren't doing the same thing at the same time, or, to use another term, have a low level of correlation. The infrastructure asset class has traditionally shown relatively low levels of correlation with many other asset classes, meaning that its inclusion in a portfolio is an effective means of helping to reduce your overall portfolio risk levels. I wanted to touch on inflation, which is clearly a very topical and important area for infrastructure and for many other reasons. There's actually no way I can really do this topic justice in the time available, but I'll make some overarching comments. I think before I do, though, it's really important to acknowledge that the performance of infrastructure assets can be impacted either positively or negatively by a range of economic factors, including things like inflation, interest rates, levels of economic activity and so on, and also by a range of other factors, which may include things such as operational matters within infrastructure assets. And the net impact on an infrastructure asset's performance and cash flows will actually depend on how all of these positive and negative impacts balance out. However, in terms of inflation, broadly speaking, many, although not all, infrastructure assets have their revenues linked to inflation. Now, this can occur in a variety of ways. As a guide, this could be, for example, through built-in inflation escalators under the concession or contractual arrangements that sit around an asset. It could be through the regulatory framework within which an asset operates, or it could even be as a result of an asset having pricing power through occupying a monopolistic position, which allows it to be able to pass through the impact of inflation to the end users of the services that the asset provides. The table on this slide contains a very general summary of our views on the potential impact of inflation on infrastructure, which I've classified into three subclasses for these purposes. However, again, I stress that the impact can vary by sector and by asset, and can also vary depending on the jurisdiction in which a particular asset is actually located. So the first category are growth-linked assets. Something like an airport is a good example of that. So if you think about, for example, Australian airports, typically Australian airports will have ASAs, aeronautical services agreements, in place with the airlines that use the airport, under which they're remunerated for providing their facilities to the airlines. Now, those ASAs will typically contain annual escalators. In addition, many airports have significant retail or property businesses, and the leases that relate to those operations will also typically contain annual escalators. Now, those escalators are sometimes linked to inflation, although sometimes they're linked to another factor, which can actually work for or against you depending on where you are in the cycle. So they're not always a perfect hedge to inflation, but they do provide at least some level of protection. And then in addition, in a growth asset like an airport, patronage tends to increase in a growth environment, which can also help offset the impact of inflation, although I do acknowledge that the growth outlook is somewhat more precarious at the current time. The second category of assets are regulated assets, so things like electricity, transmission and distribution networks. These assets tend to be more yield than growth orientated, albeit they can benefit to some extent from economic growth, although to a lesser extent than the previous category of growth assets. Many regulatory frameworks around the world are structured in such a way that inflation is essentially passed through to the end users of the services. However, this can depend on the jurisdiction in which the asset's located. In some countries, examples include Australia, New Zealand, the UK, inflation is essentially almost automatically passed through to end users the way the regulatory framework works. But in other countries, such as the US, it isn't. So you need to be aware of the regulatory system in the jurisdiction in which you're investing to really understand whether or not inflation can be passed through to end users in regulated assets. And probably the other point there is that there can actually also be a timing lag on the passing through of the impact of inflation, depending on how the relevant regulatory system works. And then the third category is PPPs, or public-private partnerships, which are often social infrastructure assets like schools, hospitals and the like. These types of assets often, although not always, but often have fixed availability style revenues, and that provides a very high level of certainty and consistency around the cash flows that the asset will generate for its investors. However, on the flip side, unlike the growth assets that I referred to a moment ago, there's very limited scope to drive increases in revenue. For most PPPs, asset revenues are actually indexed to inflation. For many of them, they're 100% indexed to inflation, albeit there are some assets which are indexed by an amount other than 100%. So for these assets, it essentially means you've got a partial hedge to inflation, leaving some residual inflation risk.
Structure. Why should I consider infrastructure in my clients' portfolios? Trent, do you want to pick that one?
Thank you, and morning, everyone. Look, I think John just touched on a lot of these points, but we've been managing our portfolio. It's a global listed infrastructure portfolio for over 15 years now. And I think for the first 5-10 years, there was a lot of education as to what role can infrastructure play in a portfolio. And I think we, in some ways, are beyond that. But if I was to break it down and give you, I guess, 3 key reasons to think about it, it would be firstly the income. This is an asset class that will give your clients a reliable, stable yield of around about 4% per annum. And I can basically tell you what the return will be for the next 3-5 years for our portfolio. Second one would be growth, and I would describe it as structural growth. So structural growth is growth that's less dependent on the economic cycle. So we all know it's a very uncertain time right now. We're potentially heading into a recession, but again, the resilience of the earnings of these companies, either regulated or long-term contracts, means that you've got good visibility on the earnings. So income, growth, and then I think the third reason would be lower volatility. For many of our clients, we're almost like a defensive equity. If you look at the returns this year, global equity is down around 15%. Infrastructure is actually up. It's only up by about 1 or 2%, but it's that downside protection in more volatile markets that it's providing to clients. So if you remember anything today, income, growth, and lower volatility.
Great, thank you. Chris, in terms of those characteristics, I mean, how does infrastructure specifically differ from other alternative asset classes in the characteristics, and why is that good relative to the others?
Yeah, sure. I guess I'd start by saying we don't really consider real assets part of the broader alternatives universe. We do consider it a separate asset class. I think we make that distinction because the first thing that we're looking for in alternatives is actually low to zero correlation with equities. That's our primary consideration when we think about alternatives. And to be clear, with listed property and infrastructure, you are not going to get that. So it's playing a slightly different role. And then in terms of other differences to alternatives, I suppose we'd say the world of alternatives is a very wide and weird world. You can do all sorts of different things that can be heavily dependent on structuring using derivatives or very high levels of gearing or very high levels of idiosyncratic skill-based type things. Whereas one of the benefits with real assets is that, I suppose from explaining it to clients' perspective and your own understanding, it's a lot more tangible than what you're getting from the alternatives universe. You know with property that roughly you want buildings that people want to work in, live in, or run a business out of, and you're going to get compensated with the rents paid for those buildings. With infrastructure, you understand at a high level that you are paying or you're investing in something that is generally at the core end of the spectrum essential to the functioning of a community. So there's a very clear story there. And also, as Trent alluded to, you have sort of a better idea over the short-term horizon of what your yield is going to look like. So it's more predictable in that way than a lot of what the alternative universe is going to get you.
Yeah, we probably end up with a similar range, and if I look across the spectrum of real assets, it sort of does vary a bit. So if you think about infrastructure to begin with, we'd see that playing more of a core role, particularly for clients at or around retirement, because given those sort of lower drawdown characteristics, that obviously can play an important role in it being one component of managing sequencing risk through a growth allocation for clients in that scenario. People with more higher growth-seeking aspirations would probably be where we would add more property, because we see property as being more cyclical, certainly higher vol, and having higher growth targets on that. So if I think about, from, people with, depending on the client scenario, more conservative end, more, sensitive to drawing, people in drawdown in particular, that's probably the key component. Infrastructure playing more of a role. Those that are probably maybe more in accumulation, longer term, might have more of a property bent to that, given the high growth features of that.
So sort of the transition to retirement, in retirement is where it plays more of a role than real estate or property?
Yeah, for sure.